Hello, welcome. Today we are going to talk about three high interest rate options that you can invest in safely today. Last 2 years must have been really difficult for many debt investors because the interest rates were so low. Bank deposits did not even beat inflation, and even the government options did not provide much returns. But with interest rates going up now, this can be a good time to lock into high rates but in safe instruments. So today we are going to see three such instruments. The first option is banks. We are not talking about the traditional banks such as your large SBIs and HDFC and Axis, in which you should have some amount definitely because they are large banks. But today, with the advent of these small finance banks offering attractive rates, you will find that with the 5 lakh deposit that the bank assurance system is providing you, and a very quick resolution within 90 days, you will find that small finance bank deposits are actually safer for you with attractive rates. So if you're going to split your money, up to 5 lakhs in an individual bank, then you can enjoy good interest rates of anywhere between 7.4 to 7.7%. For periods of less than 2 years. The sweet spot in all of these, please remember, is between 1 year and 2 years, because banks are not willing to give you high rates for longer term because they have to pay out a lot more when rates fall out. So they want to avoid it. So they are giving you higher rates for shorter periods. So that's one option for you. The second option is specifically for senior citizens. The senior citizens post office scheme at 7.4% still remains one of the best schemes to invest in for regular income, especially if you want to lock in for the longer period. Remember, you will not get these rates in banks for the longer period. So you will have to depend on these kind of government options. If you're not a senior citizen, less than 60, but still need income, there's something called RBI floating rate bonds issued by the RBI itself. It's not a bond as in you can't really sell it in the secondary market. It's just a regular bond which will earn interest. The only difference is that this interest is floating. But what the government has said that it will keep this interest rate at least 35 basis points higher than NSC certificate. So that means you will always be, it will be ensured that you get decent returns. Now, this is a good option for anybody, below 60 or above 60 who's looking for income. Please note that there is no cumulative option here. These two are very traditional options. The post office savings schemes have been around for long, etc. But what is new from the government are treasury bills, gilts or GSecs or government securities as they are called, and state development loans. All of these are auctioned by the government almost every week, and is available on the RBI's direct retail platform. It is also available with select brokerages, but the RBI direct platform will ensure that you have access to almost all the instruments that they auction on a weekly basis. Now let's take a look at each of these and their uses. Treasury bills are very short-term options to invest in for less than 1 year. Currently, their yields are anywhere between 6.36 to 6.92. Remember, your savings bank is going to give you just a little over 4, and short-term deposits of less than 1 year will give you 4.5 to 5.5. But these offer you much higher returns now, and I think it's a great way to lock into these rates if you just need to park money for the short term. Here there is no interest. The treasury bill is issued at a discount, and it is kind of given to you at face value. So it's a great option if you do have a RBI direct retail account. The next is state development loans. These are nothing but bonds issued by state governments. Different state governments issue for varying periods. It could be 5-year, it could be even 20-year, and so on. But we find the rates in the 3 to 7-year period quite attractive. Between 7.46 and 7.72. You might think that some states are very risky. They have high loans, very high debt and so on. Yes, they are. But the good thing is this repayment of this is done by the RBI. So the RBI ensures that it takes out from the state's account whatever it is and pays you. So to that extent, there is an element of high safety in these, although they are state governments. And these are ideally buy and hold instruments because they may not have much liquidity in the secondary market. Although they're supposed to be traded in the exchanges, they may not have liquidity. So if you need liquidity, if you want to sell before the maturity, you need to make sure you buy those bonds from large states that have large issuances. Here, interest is paid out every half year. There is no cumulative option, and is again a very ideal tool for those looking for good income to beat inflation, etc. The third, of course, is the government security or the gilt or the GSecs as we call it. This rates too are attractive, and you can go even up to 10 years in these because these enjoy much higher liquidity. So tomorrow, if you wish to sell them, you may be able to do it quite well. Especially the 10-year has high liquidity. The ones in between 6, 7, the odd lot as they call it, may or may not have liquidity, but we recommend them as buy and hold. Again, interest is paid out half yearly. It's very safe if you hold till maturity. Please note that you might see ups and downs in the price of these bonds in between. They are called mark-to-market losses or gains. Don't worry about it if your intent is to hold them till maturity. So that's another option, but all these are income options. What if you don't want an income option but want your money to grow? Then mutual funds come to your aid. We don't want to take calls on which fund manager is best, which fund credit is high or low, etc. if you are not an active mutual fund investor, right? So the best way to go for is passive debt options. These are nothing but debt index funds, right? In India, in the last few years, target date maturity funds that are open-ended but with a fixed maturity. You can sell them anytime in between, but you can also hold them till maturity. If you hold them till maturity, the yields that I've given here between 7.25 to 7.7, you get for bonds in the 6 month to 7 year, debt funds in the 6 month to 7 year time frame. These are very attractive yields. Most of these debt funds invest either in the state development loans that we just spoke about, or the government securities, or PSU bonds, public sector bonds. So all of them are AAA rated and high credit worthiness. So this is the range that you get. Remember, they don't go into lower rated bonds. They cannot. All of these debt funds have to mimic certain indices, the underlying indices, and all of these indices that are there currently invest only in a combination of what I just mentioned. So there is no credit risk per se. Again, the price may go up or down, but you need not worry if you're simply going to lock in and wait till maturity. Then roughly this is the yield that you will get, less the expenses that you might kind of have. Now all of these have very specific taxation, whether it's the debt funds or it's the sovereign guarantee SDL. You might want to check our article on what those taxation is. As for the passive debt funds, we have specifically come up with recommendations on few of them. You will find them in the links that we have mentioned here. We will also put those links below the this video. So that's about it. 3 great options for you to invest in. If you like this video, please give your comment and also subscribe to our channel so that you can get more useful inputs. Thank you.